podcast of the quarter of the month. Although tomorrow is still Friday, there's another day to dance, but we don't dance on Fridays, at least not at the moment. Oil prices are currently opening in Asia this morning, and they're looking pretty solid. They want to get back to that $90 a barrel mark. They're addicted to it. That's the sort of barnacle on the rock number. Let's go to Ed Bell, Senior Director, Market Economics at Emirates MBD. Ed, your thoughts on the outlook as we come to the end of this week when there was so much drama? Is oil prices or Brent returning to 90 because of existing tightness in the market or concerns about future supply disruptions? Your thoughts this morning?
Well, I think what's happening in oil markets, commodity markets, currency markets, bond markets is actually nothing to do with the fundamentals of the specific underlying market. It's all based in what happened in Downing Street at the end of last week and the responses from the Bank of England in the last few days. So it is really financial market volatility that is determining things. When we look at it from the fundamentals point of view,
connect that for me into the oil markets. Then, what's the dot plot from 10 Downing Street to $90 oil?
Sure, it's just the risk on, risk off sentiment that is dominating everything. It's the tides coming in and out, and it's catching up markets that are completely disconnected to it, such as the oil market or copper or iron ore or what have you. So if anybody's got a multi-asset portfolio that does dip into commodities, hey, now might be the time. If you're concerned about a big blow up in some other part of your UK gilt position or any sterling denominated, you might want to sell out of anything to cover those kind of losses. That being said, when we look at the fundamentals for the oil market, we still expect to see prices going higher from where they had gotten to. So yeah, if it's $90 a barrel, looking at a more fair value price for the remainder of 2022 and going into next year, even higher, as the supply story still remains extremely constrained. I think the headlines really since the summertime have been dominated by we are in a recession, we're going into recession, etc. Central bank tightening, blah, blah, around the world, China is not consuming oil, etc. Ignoring the fact that no additional oil has been coming out, right? We had the data out from the EIA last night, another dip downwards in US oil production, admittedly small, but basically that number has held at 12 million barrels a day for the year as a whole. It is not going up. The United States is not increasing oil production. OPEC Plus meets next week. We're probably going to have another sizable production cut from them. So even if we have a global recession.
Sorry, are you saying that next week we're going to have a sizable cut from OPEC Plus?
I would expect to see something more meaningful than the 100 KBD that they have outlined for October. If they get, we had this sort of endorsement from Russia of 1 million barrels a day. Maybe that's a step too far. But whatever it is, if it's, let's say, 500K that gets agreed, you have to consider it's actually going to be substantially bigger than that, given that most OPEC Plus countries aren't hitting their targets anyways. You can probably add 20%.
Well, before we get too down the sort of the OPEC rabbit hole, because clearly that is a big another factor. Malia Bengali, founder, MB Commodity Corner, wanted to get your thoughts picking up from Ed's opening comments there. Contagion from Downing Street to everything else. Although to me, it just looks like another big bottle of volatility. This week's it happens to be, suicide on 10 Downing Street. The weeks before was something else. Your thoughts on that contagion?
You're absolutely right, Sean. Ed made a very good point, because right now the market correlation across assets is very close to one. I mean, bond, equities, rates, commodities, all moving sort of tandem with the global macro cycle, which is negative for right now. What's interesting, what happened in the bond market in the UK side is that, obviously a lot of UK pension funds had their assets and liabilities mismatched, and there were margin calls, which obviously stressed the Bank of England to go and buy this gilt. Now, if you take a look at what they're doing, they actually never even started QT. They're doing QE at a time when inflation is close to 10%. It's suicide. So you are pretty much cementing inflation for a long term. The sterling rallied a little bit, but I think this is actually reminds you a bit like '08. The central banks are panicking, where you get a little bit of a short-term reaction, but we think something is actually really breaking in the system. Now, going back to the US bond market, it's not just a UK bond market phenomena. Real rates in the US are rallying and the bond markets are collapsing. The US 10-year trading close to 4%. The Fed cannot do anything right now until something systemically collapses in the system or inflation is back down to 2%. Their benchmark has been labor market, which has been very, very strong, but we know that's a backward-looking indicator, and the Fed always reacts after a crisis as opposed to preempt one. So something is snapping, but we are very concerned about the way macro asset classes are trading. Bond markets are a very big asset class. The volatility is not normal. This is almost like some things are breaking. So we spoke about this a few weeks ago as well on our call, right? We said it's like a Jenga tower. So when one thing snaps, the whole system is pretty much levered to the same sort of aspect. So it's quite bearish for us, and we don't think these are like emergency measures, which are not really a good long-term solution. They're more like stemming the gap in the short term, which is not usually very stable.
Let's go to Daniel Rahmat, Senior Energy Security Consultant based in Tehran. Of course, sort of getting down to the streets of tangible life. Serious week in Iran. Daniel, as much as you're able to share with us what it looks like from there, and what do you think the outlook for this current sort of period of instability in Iran? We've seen this movie before. It doesn't end well, and it doesn't really change anything at the end of the day. Your thoughts?
Hello, everybody. We're very glad to be here again. Uprising is going on here in Iran, and there are very severe clashes between security forces and people in the streets. And what people are asking for this time is somehow very much more obvious comparing with the previous time. It was some economic claims and some blames for increasing the gas price in the country, but right now the story is pretty different, and it started from when actually I don't know what to call it, but murder of a girl in the mortality police in Tehran. But anyway, I agree with you. At the end of the day, nothing has changed in the previous demonstrations, and people's demand was not realized. But in fact, it's really based on my understanding, this time it was caused by the pressures of the oil sanctions in Iran, because the overall income of the government has decreased for several years, and the government's capability for controlling the economic issues and managing the economic affairs of the country has significantly lowered. And considering the new government in Iran's turn to Russia instead of China, the hopes for increasing the oil sales to China has also declined between the experts. So there is very little hope for increasing the exports to China based on a sort of a strategic deal or strategic alliance between Iran and China, because Russia itself is a competitor with the Islamic Republic in terms of oil production and oil sales. So this could be also another concern between the elite economists of the country, which have serious concerns about the future of the Iranian nuclear deal. As you remember before, we talked that if even the nuclear deal is not made, Iran could somehow sustain its exports to China with a sort of strategic partnership or sort of deal. But the current government in Iran's policy to get more aligned with the Putin's policy would endanger the whole oil exports of the country, which would more darken the horizons of the country's economy.
Ed, just picking up again on the OPEC piece, clearly at the current situation, oil prices are climbing back to $90 after testing the low 80s. That's Brent. And so one would say OPEC meeting near 90, that seems quite comfortable. That's a lovely price. If I could bake that in for 12 months, I'd bite your hand off for it. Why do you think OPEC Plus would move to a cut, given that number is still quite a chunky one? Everybody's in fiscal surplus.
I think we remain in an enormously volatile scenario. And also, if they do outline that there is an expectation for a global recession, that China does not end its COVID zero policy, that you have, interrupted demand story there, or you have much slower growth in the Eurozone, in the United States and elsewhere, does the world need OPEC Plus to maintain production at its optimal or sort of highest level, unwinding all the pandemic related cuts, or even increase output? I think they would respond, and this is what we saw at the meeting at the start of September, that they want to be able to respond in a bi-directional manner, so increasing, decreasing production as the economic conditions warrant.
Well, let's just look at that from the point of view of what that means, because ultimately they're 3 million above reality. So how do they communicate that in some tangible way that it has an impact on market sentiment as well as actual barrels?
Yeah, I think that's what's really they're going to be doing, is not necessarily changing the actual physical balance in the market, but just sending the signal that they are prepared to step in and arrest any volatility on the downside. You know, it's interesting, we never hear about volatility on the upside from OPEC plus ministers. You know, you can understand that given where the economies are based and the kind of dependency that they have on oil and gas incomes, but really to avoid trying to see prices falling with the same kind of speed and rapidity that we saw over the last couple of months. It can be a little bit of a question of, are you trying to catch a knife on the way down, though? If we have a big cut, that could get, and that could look sort of positive from a fundamentals in terms of supporting higher oil prices. But if we don't see any other change, or we see more volatility stemming from non-oil market variables, financial markets, the Chinese yuan at a record low, and the people that seems to be being buried in this market at this time, all of these are a lot of noise for the oil markets, but none of them are positive, and they can have a big outsized influence on them, even if they don't have any real connection to the fundamentals.
Maliha, of course, the big story in the last few days, which continues to sort of have ripples, obviously the UK story, as Ed led with that, but the other big one is the bombing of the Nord Stream pipeline, gas pipeline from Russia to Germany, now discovering apparently just this morning he had a fourth leak, which I presume a leak means it must be of scale given what we're seeing in the top of the water. But this is a real escalation of the sort of weaponization of energy, let's just say. I mean, it's literally a physical infrastructure piece of great strategic importance, although given what's happened, that pipeline had already depleted, given that obviously the gas supplies from Russia. But nonetheless, to take the war into energy infrastructure, where do you think that goes? How does the market digest that? And, you know, next step, obviously the Norway pipeline is not far away from that location.
You're absolutely right. I think this taking the whole sort of energy markets and war into a new dynamic altogether. It's very hard to tell, but I think we should take it one step at a time. Now, the Nord Stream pipeline has pretty much accounted for 0% flows going into the winter, but obviously some issue about the Ukraine pipelines is an issue. US LNG is there to support the EU market needs, and we know that Europe has done a very good job in preempting a very tight winter. So we're close to about 89% storage for this winter. Obviously, if you have a very cold snap at the US and here, there could be some issues. The market's uncertain right now regarding the actual gas needs, but we know that next year it will be a massive issue because you can't rely on Russian imports to fill up storage into next summer, next winter. And obviously, countries are now coming to Qatar or UAE to sort of source better LNG from other sources. But you are right, this changed the dynamic a little bit. Going out of gas into oil a little bit, it's still a bit unclear as to how that works out. There's been a lot of talk about this demand pickup in Q4 from gas to oil switching. We're seeing that sort of demand uptake helping Q4 anyway. But there's so many other macro factors in terms of the demand slowdown. We know supply is tight, but demand is the massive variable. And this is something that OPEC is battling with, because the reason why oil prices surged massively in 2020 and 2020 and right now they're falling, there is a speculative demand aspect of the global economy that you can't really factor in. So we think if OPEC plus talking about a cut would actually be a very risky move, because that would be almost hitting the economy at a time of inflation where energy is a massive input cost to global goods. So your economy is falling and you're going to basically look at just your oil markets from a micro point of view would be a very short-termist point of view, because I think end of the day, energy prices falling would help the global economy longer term. It remains to be seen, but you are right. We need to watch to see if any sort of infrastructures is attacked. That's not being priced in right now. But gas is very different from oil in terms of just into the winter.
It is different, but ultimately one has to. I mean, it seems that repeatedly we don't learn from. We keep expecting Putin to become Gorbachev. The guy is blowing up pipelines. I mean, what's next? He's cutting off gas. I mean, the oil obviously is next. I mean, it is the nuclear option in terms of the weaponization of energy, and one would have to assume he's not going to stand by and wait for the Europeans to embargo him. I would imagine he'll be the first on that step. Daniel, just to pick up on your earlier point vis-a-vis the relationship between Iran and Russia right now, it does seem there's a lot of sort of commentary around the fact that Russia is actually the obstruction of Iran being able to get towards a JCPOA renewal and the release of all of its oil onto the markets, because of course that would take leverage away from Russia at this time of tightness. How does that sort of analysis digest in Tehran? Does that make sense? Is it not? Your thoughts?
Yeah, normally I think since Russia, because of two very strategic bases their foreign policy has. One of them is their geopolitical strategy, which they call the heartland, or recently the Eurasian geopolitical theory. Their plan is to make a set of the smaller and big countries as a belt surrounding the Russia as the first front against any foreign invasion or something. And that was the principle of invading Ukraine, for keeping Ukraine as a sort of their own security belt. And now they consider Iran as one of those countries which could be considered as the security belt of the Russian Federation. And on the second hand,
is Iran willing to be such a thing?
Of course, there are disputes about this. You know, some politicians here believe that being a part of the Russian security belt would result into becoming under the Russian security umbrella and having access to Russian weapons and Russian economy. And then Iran can play a role like a sort of transportation role, something like that for the Russian the Russian Federation, and also receiving cheap oil and gas and oil products from Russia. So that would mean having a lot of benefit under the sanction situation. They believe that this could be a sort of bypassing the sanctions through the infrastructure in the Russian Federation. And the others believe that because Iran has a lot of resources itself and it can easily get to a sort of strategic deal with the West, maybe that would be a disastrous decision to become part of the Russian Federation security belt. You know, watching the experience of the other countries like Ukraine, Armenia, other countries who have already trusted to become a part of the Russian Federation, you know, to become a part of the Russia's security strategy. It shows us that whenever you want to get out of that strategy, you will face disastrous consequences. So this catastrophe which is going on in Ukraine shows that Russians are very harsh when facing somebody who wants to get out of the Russians' influence. So anyway, I personally believe that at the current situation, many in Iran disagree with what I call the Russians or over-influence in Iran, because Russia can be a sort of partner for Iran in terms of energy, security, military, economy, or everything. But in the current situation, I think some things are going wrong. But may tell you something about the gas issue going on in South Stream. You know, there is one thing we need to consider about the South Stream 1, the explosion of South Stream pipeline 1 and 2.
Right.
You know, the more Russia exports less gas to the Europe or elsewhere, the less gas condensate would be produced in Russia. So we are going to face a very severe gas condensate supply. And, you know, Iran as a very huge gas condensate supplier is going to have a actually easier, smoother playground for selling its gas condensate in the black market. You know, at the moment, Chinese companies, very small refineries and petrochemical plants import Iranian gas condensates, and Iran sells gas condensate to Venezuela, sometimes in domestic market and sometimes in black market to countries where no one knows where. But I think since now on, the lack of gas condensate in the market is going to be more serious, and Iran is going to have an easier playground to sell its gas condensate. As you know, half of they said about 90 million barrels of Iranian floating reserves is the gas condensate. So Iran is going to sell them easier.
Okay, let's get the survey question up and just think about this a little bit in terms of Brent returning to $90 a barrel because of current supply tightness or future supply concerns? I mean, Ed mentioned there, I think, that US oil production is not getting above 12, even though most other major oil producers have got back to pre-COVID levels. The US has not. SPR is at 35-year low. 5-year averages are way down. There's a huge hurricane hitting the Gulf of Mexico. There's some very normal, real stuff that challenges current supply tightness. Then, of course, there's the future supply concerns. The idea of the war in Ukraine, the disruption from that, the obvious embargo coming against Russian oil. So the movement towards back to 90, is it reflective of current supply tightness or future supply concerns? It's hard to split those hairs, but I wanted to try and get into that this morning. Ed, I wanted to get an update from you because it is really a currency week in so many ways. You mentioned the yuan, the sterling is still hanging on. The euro's already crashed through parity. And here we are in the Gulf with a very bionic peg to the dollar. Just regionally, let's just attack that first. How good is that? Is that an all win for the Middle East, for the Gulf? What are your thoughts on the dollar strength and its sort of ripples?
Yeah, as ever, a stronger dollar and consequently a stronger dirham, a stronger real, it's always a double-edged sword in that it helps to insulate the domestic economies from a lot of imported inflation, given that our currencies are appreciating in line with the dollar against others that might be exporting to the country. So, in terms of the balance of payments for UAE at the big kind of textbook macroeconomy level, it's kind of okay and relatively a positive in that sense. And also, I think with the way oil prices are and the buildup in central bank reserves, the ability to support and defend the pegs is really not in question at any time right now. And I think generally when we do not have a view that there's going to be any imminent move away from the peg currencies, but if you look at it from the kind of economic fundamentals, if there was a shift, more likely in the dirham's case, for instance, you'd actually see it appreciate rather than depreciate in the immediate. On the other hand, though, the stronger dollar, stronger dirham is a negative in terms of the competitiveness of the non-oil exports for the country. So it always makes things a little bit more expensive. In particular, if we think about Dubai and the UAE, given that they are very open, tourism dependent, very open, very tourism dependent economy. And hey, where is the dirham strengthening quite a lot against key sort of source markets for tourists? UK, Eurozone, Indian rupee, all of these ones enduring quite a lot of depreciation against the local currency here, so making it relatively more expensive. We do have, the mega event of the World Cup in a couple of months' time, which is notionally should be supportive for tourism coming into it. But as discussing with a colleague of mine, we sort of grow accustomed to the idea that, a pint of beer in Dubai is roughly about 10 pounds. Well, now it's going to feel a lot more expensive than that for any tourist coming over here who wants to spend some time in a fan zone or maybe jetting up and down to Qatar. So it is going to feel like a relatively more expensive holiday season, traditional holiday season in the sort of Q4, Q1 timeframe.
And England football team, it doesn't look very exciting at the moment. So maybe that'll add to the extra not doing. Malia, picking up on that, maybe bringing it out to a global point of view, the global currency issues, dollar yen, my goodness, dollar won records, sterling records everywhere. What's the big sort of global ramifications of strong dollar, and do you see it lasting?
I think the big problem right now is not only the sterling. Look at the yuan. You mentioned that right now we're way past the 7 psychological mark, trading at 7.23, and that sort of devaluation for the yuan is in line with what's happening to Asian currencies. So this sort of dollar appreciation is going to keep going till the Fed actually stops raising rates. It's not just about the other currencies. We know that they're basically printing. We saw the BOE. They're actually printing money to then raise rates, and it's not really going to combat inflation. So right now the dollar is the lesser of the evil, so to speak, and it's going to be raising against other currencies. The minute the Fed pivots, if it does at some point in the future, that's when the other currencies will rally. But this is actually bearish for risk assets in general, because we know the dollar world is indebted about $21 trillion. So this debt squeeze is very negative for risk assets, emerging markets, and the world can't handle this dollar debt squeeze effectively. And the stop will be when the Fed pivots. And right now the Fed has no justification to stop its rate tightening cycle. We are still above March 2020 levels. The markets are not down more than 20%.
Daniel, looking at the outlook, I was just noting we've seen this week the German chancellor in the region, most notably in seeking new gas supplies, and then with that coming to the surface, obviously Qatar's massive increase in LNG capacity from 77 million tons to 126, which is its destination, which is a very, very big number. And of course, Iran shares that same gas field with Qatar, and can also has the option to stick the straw in and take their own amount out. But I'm just want to ask if from an Iran perspective, the scale of development in Qatar, is that an issue? Is it not an issue, given that Iran is not harvesting much of its side of that reservoir?
First of all, there was recently an agreement between Iran and Gazprom, and IOC and Gazprom, to develop some phases of the South Pars and increasing the production in the existing phases. And on the other hand, there was some recent explorations close to South Pars, shows more oil fields close to that, and also some gas fields. They need to be proved, but I think the South Pars in the Iranian side is larger than expected before. But there was also another contract, another MOU, between Iran and Gazprom to develop North Pars, another gas field close to South Pars, which is the Iranian side of the North Dome in Qatar. But that takes time. It's not immediately going to result in increasing production and actually developing the field, but also considering the capabilities of NIOC and also Gazprom, comparing with the other giants are going to develop the North Dome in Qatar. Qatar is going to develop its side, it's the Qatari side of the field, much faster than Iran. And I think, but let's consider some more issues. The Iranian gas fields are not limited to South Pars, and Iran has other huge oil and gas fields, especially which are easier to extract. But the main point that Iran is emphasizing and developing the field is because it's shared with Qatar. We also need to consider another development which has recently happened. Iran is pursuing to import as much as 20 billion cubic meters of gas from Russia. Something more than 20% of the spare gas production capacity in Russia, which is not going to be exported to Europe anymore. I'm not sure about the prices, but Iranian officials are emphasizing that the prices are very interesting. So if that huge amount of gas is imported from Russia, either from Turkmenistan, where Iranian pipelines is connected to the Turkmen pipeline network, or from Azerbaijan, Iran could somehow increase its exports to Turkey, to Iraq, or even to Pakistan, where Russians are very interested to export gas to.
That does seem like that seems to be part of that kind of medium 5-year plus idea of where does the world go with all of these new energy flows. And indeed, a bit like stuck in Jay Powell's universe last year, is this temporary or is this permanent? And make your bets now with $50 billion that it's permanent, and so all of this infrastructure, it will be built for the new world, or is it temporary? And so I'm not spending my $50 billion because gas flows and energy flows will return. We're not going to sort that out this week, and it's not going to impact the markets this week that much. But nonetheless, I think those questions start to become on the horizon. And certainly in the context of the Europeans coming to the Middle East to do gas deals, unless they can show the Qataris and others that they've got a 20 or 30 year horizon, it's going to be a struggle to get that gas to Europe. that's another question for another day. Listen, the answer to the survey, let's see what it is before we leave you and post on social media. So the Rube thinks current supply tightness is really the driving factor this week. Let's get that up on Twitter and elsewhere and see what the rest of the world thinks about that. End of the quarter, Malia Bagali, thank you so much as always. Ed Bell, thank you. Daniel, thank you. Hopefully we'll see all of you in Fujairah next week, where we will be having our first in-forum gathering, in-person gathering for Gulf Intelligence for the first time in 3 years. It's hard to believe. It's been that long, and at the same token, it just seems like yesterday. But back to live forums, it'll be great to be there. This is an incredible photo, actually, which is seeing up on your screen at the moment, which is actually an aerial shot of the new railroad that's being built from Abu Dhabi through the Fujairah Mountains to the port of Fujairah. And that is a huge new piece of infrastructure kit that will change things a little bit. All the best. Have a great week and weekend. Thank you.